Hello everyone, thank you so much for joining again. Today a very important topic and a topic not well taught in business schools. Topic for today is what is leverage in finance? And the quick answer, as many of you know, is use of debt. No, it's not. It's only partially correct. Leverage in finance does not only mean use of debt. Leverage in finance means use of fixed costs. That sounds weird. Use of fixed costs, how that? I always thought it is only about debt financing, capital structure. I come to this, but broadly speaking, leverage in finance is the use of fixed cost. And what we can think about, there are two types of leverage, is operating leverage and financial leverage. And again, use of fixed cost. If we think about financial leverage, yes, now you're correct, debt. Because when we use debt for our operations, then we increase our fixed costs. Why? Because interest payments are fixed. They are not related to our revenue figure, number of sales, number of units sold. It's based on your contract. You pay regular, stable interest payments to your debt holders. So your interest payments are fixed. That's why financial leverage, use of debt, means use of fixed costs. If we think about operating leverage, as you may know, we have cost of goods sold, SG&A. I like to think more about COGS as indirect and SG&A direct and SG&A indirect cost. But both of those items, they have a mix of variable cost and fixed cost. Usually cost of goods sold, more variable components, SG&A more fixed component, but it's not crystal clear. You can't say SG&A has only fixed cost component. But in general, your cost items that you have, and there are other cost items in the business, usually it's a mix of variable cost and fixed cost. And here again, if we look at our fixed cost component, the more fixed cost we use, the higher our operating leverage, similar to the more debt we use on the finance side. Yeah, it's quite important because for two reasons. First, fixed costs can increase your return, on sales if your revenue numbers increase, and can also increase your return on equity for your equity holders because you use less of your own money, you supplement your investment with debt, and then the residual cash flow, the return you have, increases more because you use debt as well. So you have a positive effect because it can increase or improve your return. But also, and this is a risk factor, it increases your company risk because, as we will see, leverage, be it operating leverage or financial leverage, makes your company more volatile. And as we know, risk in finance is not about how much money you lose, it's all about volatility. Yeah, very important. I do a few examples now for you to illustrate the impact of fixed costs from operating side and the use of interest payments. And then what I do, I explain you when we look at the cost of capital of a company, how use of operating leverage and financial leverage affects cost of equity. Okay, let's get started. Looks complicated, but is not. We have 4 different scenarios. We have a very simple income statement, starts with revenue here on the top left, variable cost, fixed cost, don't need to go in detail. Then you have your operating income. Sometimes it's EBIT from an accounting perspective, or EBITDA. Doesn't really matter, it's your income after you have deducted your costs. Then you have your interest payments, and then I have excluded tax for simplicity purposes. Then you have your net income. And then return on sales is your net income divided by revenue, and your return on equity is your net income divided by equity. What we assume is we have 1,000 total shareholders' equity and liabilities. For the case that has no financial leverage, no debt, no financial leverage, we assume 1,000 in equity, 1,000 in equity. This is just an example. For the case that has debt, and debt, high financial leverage, we assume the structure is as follows: 50% debt, 50% equity, and we assume our interest payments are paid at 10%. These are our interest costs. For all the cases that have no financial leverage, we just assume no debt, 1,000 in equity. Yeah, OL means operating leverage. We have one case that has high operating leverage, no financial leverage, one case low operating leverage, high financial leverage, and then we have one case that has both. So what I've done, I started already. Revenue 1,000, 500, 100, 600 deduct, 400, interest 0. Net income 400 means your return on sales is 40%, 400, and return on equity is 400 divided by your 1,000 equity, which is 40% as well. Yeah. I have done this for all the other cases already. As you can see, 1,500 and so on. It's quite simple. What you can see here, variable costs are all the same, 500, 500, 500, 500. What you see here, fixed cost for the low OL is 100, 100, whereas here for the high operating leverage scenarios, we have 300 and 300. Here, because we have high and high. And then when we look at financial leverage here, the only difference is that we have interest 50 here, high financial leverage, 50 interest here, and here we don't have. Yeah, so you can see low operating leverage. For those here you can see high financial leverage, high financial leverage, here the blue ones, and here high operating leverage. Yeah. So what I want to do, and this is where we can see the biggest change, I want to do 2 examples for each scenario. One is if we have revenue increase 10% and revenue decrease by 10% as well. Let's get started with the first one. Revenue decrease by 10% means 900. Your variable cost, let's assume again, our assumption is variable cost at 50% of revenue. The higher the revenue, the higher the variable cost. Our fixed cost, they won't change because they are fixed. Yeah, so we have 900, then we have 450. Fixed cost is 100 remains, so we have 350 here. Interest 0 because it's no financial leverage case, so we have a net income 350. net income over revenue. What we have 350 divided by 900. I'm rounding. 350 divided 900, 39%. And then ROE is 35% because 350 over 1,000 equity. Yeah, let's go to the other case. 1,100, 550. This remains at 100. Then this is 450. This is 0 because it's still no financial leverage. This one is 450. So if we have 450 over divided by 1,100, we have approximately 450 divided 1100, approximately 41%, and then here 45%. Yeah, because 450 over 1,000, the equity number does not change. Your sales number, your revenue number changes. Good. Let's go to the next case. Again, plus 10%, minus 10%, 900, 1100, 450, 550. This remains at 300, so 400, so you have 150 here. And then this remains at 300, 250 here, 0, 0. Then what you have 150 here, 250 here. So then if we look at return on sales, we have 150 over 900. And this is approximately 17%. And then what we have here, this is our case where revenue has increased by 10%. Our return on sales is 250 over 1,100, which is approximately 23%. And then our return on equity is 15% and here 25%. 250 net income over equity, our equity remains. Yeah. Let's do the financial leverage case. 900, 1,100, 450, 550, fixed costs remain. 100, it's a low operating leverage case, that's why it's only 100. 450, correct. Then we deduct still 50. Again, interests are fixed costs, so they are not changing whether we decrease or increase revenue. They are based on the outstanding debt. It's 50-50, so we have 300 and 400 here. If we have return on sales, it's 300 divided by 900, which is easy, is 33%. And then on the other hand, we have 400 divided by 1,100. It's approximately 36%. And then return on equity here, this is different now. You take the 300, but you don't divide the 300 as we have done before by 1,000 equity. Your capital structure is 50-50, 50% debt, 50% equity. So you take 500 equity only. So you have 300 divided by 500, 60%. And then what we also have is 400 divided by 500 is 80%. Good. Let's stop here. I leave the last example for you if you want to go through and have a look. What can we see? So we can see two things. The first one is if we increase operating leverage, as we have done from the base case to the operating leverage case, we can see that our return on sales is more volatile. What does it mean? Here our range is 2%, from 39 worst case to 41 best case. So if sales increase or revenue increase by 10%, our net income increases by 1%. If sales decrease by 1%, by 10% here, if sales decrease by 10%, our net income decreases by 1%. If we include operating leverage and have a higher fixed cost base, then volatility increases 6%, which means 10% increase in sales plus 10%, and this should be minus 10%, plus 10% in sales lead to plus 3% in net income. So you have a higher return. Yeah, your return is higher, but also more risk, because if something happens to your sales figures and if revenue decline, your net income is also affected more negatively than before. So this is the first one. The second effect, especially when we look at the difference between our base case and our high financial leverage case, the difference you can see even without a change in revenue, it's all the same. The revenue numbers are exactly the same, so every single number here is more or less the same compared to here, except those interest payments that you need to pay. But your return on equity has dramatically improved from 40% to 70%. And the only effect is you have to pay $50 in this case interest payment, because you have used debt and your equity. So more return is available, or the same return, more or less, the same net income, the difference is only 50, the same net income is now available to a lower number of shareholders. So you don't need to share the net income amount with a large group of people. The number here is shared with a lower number, so your return has increased. Yeah, and what you can also see again, if you include fixed cost, volatility here is 10%. That's what we call risk in finance, volatility. 10%, 35% to 45%. And here it is 20%. So if something happens, your return does not decrease by only 5%. Here it actually decreases by 10%. Yeah, and the same here, 3% compared to the initial 2%. Yeah, because you have another fixed cost component. Whenever you have an additional fixed cost component, your return on sales or your return on equity is more volatile. Yeah, so that is what we call leverage in finance. Financial leverage, use of fixed cost, which is debt, interest payments, or use of operating leverage, in this case fixed cost here. They all have a certain effect on your return, on the volatility. And what does it mean for your cost of equity? As you know, our return on equity, if we use capital asset pricing model, equals risk-free rate plus beta market risk minus risk-free rate. And what does it mean? Cost of equity is basically the return equity holders request for investing in this company. Your risk-free rate usually is like a US Treasury bond. This is potentially your S&P 500, like a broad stock market index. And here again you have your US Treasury bond or another fixed income instrument that we can consider risk-free, usually a government bond long-term. So nothing really changes here. So if you include more fixed cost or more interest payments, the formulas not really change, because this is an external number, this is an external number, this is an external number. The only thing that we will touch is our beta. And in general, beta is driven by three things. First, operating leverage. Second, financial leverage. And third, which we can't see in the example, volatility of sales. Operating leverage, we talked about it. The higher operating leverage, the more we have, the more volatile, the more risky is your business, so your beta will increase. The higher your financial leverage, the higher your debt amount in the business, the higher your financial leverage. And I have done a video on Hamada equation where you can see the effect as well. And then the last part is volatility of sales, which we can't see in those formulas. But if you think about operating leverage affects this one, from revenue to operating income. Financial leverage affects from operating income to net income. And then volatility of sales is basically how volatile is your revenue number in the first place. Is it actually increasing to 10% or decreasing by 10%? How volatile is it in the first place? If it's a utility company, it's quite stable. Mining business, quite stable. If it's something more consumer focused, automotive companies, it's a bit more volatile, which is all reflected in your beta, which will drive cost of equity, which will basically change how you discount your free cash flows to equity holders, which will affect your valuation. Yeah. So again, leverage in finance, use of fixed cost, operating leverage, financial leverage, mainly fixed cost operating and interest payments, and the effect on valuation or cost of equity goes via beta. Beta is driven by those three things: operating leverage, financial leverage, and volatility of sales in the first place. Thank you so much for listening. Hope you found this useful. See you later.